Hello, everyone, and welcome back to the Deep Dive. Today, we are taking a hard look at a company that is, well, an absolute fortress in the retail space, the mighty AutoZone.
It's a fascinating one. It's really a crucial case study for anyone trying to understand what a high-quality business looks like in today's market.
It really is. But here's the billion-dollar question, or in this case, the $56 billion question. Why is a company that sells oil filters and brake pads trading at a valuation that you normally see for a high-flying tech stock?
Exactly.
Is it a permanent compounding machine, or is it the very definition of a quality trap? Just, waiting to catch unsuspecting investors. That's what we're here to figure out.
That's the whole puzzle we need to solve today. Is it this untouchable fortress built on, the fact that cars break down? Or is it a genuinely great business that's just trading at a bad price, meaning your future returns are going to be, well, pretty muted?
Okay, before we dive in, let's just ground this conversation in some real numbers.
Right.
As of today, January 11th, 2026, the stock is trading around $3,300 a share.
That's a huge topic. Before we really get into the weeds, just a quick heads up for everyone listening.
Right. If you're looking to invest, we use Interactive Brokers.
Hmm.
If you use the link in the description, you can get a stock bonus when you sign up.
Yep, it's a great way to get a bonus, and it really helps support the channel.
And while you're down there, please do us a favor and hit like, subscribe, and drop any questions you have in the comments. We do read them all.
All right, let's get into it. So let's start with the business model, the real engine of this thing.
So you were mentioning the valuation multiples. Let's start there.
Yeah, they are undeniably premium. The trailing 12-month PE ratio is sitting at almost 24.
24 times earnings. And the enterprise value to EBITDA is what, around 16?
16.4, yeah. I mean, those are numbers you expect from a company growing its revenue at 20-30% a year, not a brick-and-mortar retailer.
But the financials underneath, they almost justify it. The return on invested capital, the ROIC, it's just phenomenal.
It is. Depending on how you calculate it, you see numbers from 25% all the way up to almost 50%. Either way, it just screams efficiency.
It shows that management knows exactly what they're doing with every dollar.
Absolutely. But here's the catch. For anyone looking to invest right now, the free cash flow yield is only around 3, maybe 3.5%.
Which tells you you're paying a massive premium for all that quality. You're basically pricing in perfection from here on out.
You are buying perfection. So let's start by unpacking that perfection.
Okay, let's do it. Let's start with the core business. You called it the black box of failure demand. What exactly do you mean by that?
Well, it means the whole reason people shop there is compulsion. It's not desire, it's not convenience.
Right, it's not like you're browsing Amazon for fun on a Tuesday night.
Exactly. The whole business is driven by what we call failure demand.
And what does that look like in the real world for, the average person?
Well, we've all been there. Picture this. It's Monday morning, you're already late for work, you get in the car, and it just won't start. Or that check engine light starts flashing bright red.
Oh, the worst feeling.
Right. At that moment, you are not comparison shopping online for 2 weeks to save $5. You need that alternator or that battery, and you need it now.
And that urgency, that immediate need, that's the bedrock of their whole business model, isn't it? Especially now with the cost of new cars being just astronomical.
Precisely. For most people, buying a new car just isn't an option. So it's either fix the one you have or your whole life gets disrupted.
So the cost of not buying the part is way, way higher than the actual cost of the part itself.
And that's what gives them so much pricing power. We've seen all this inflation over the last couple of years, right? Shipping, materials, everything's gone up.
Sure.
A lot of retailers had to just eat those costs. AutoZone, they've been able to pass it right along to the customer.
How can we see that in the numbers? Like, what's the proof?
You just have to look at their gross margins. They've stayed rock solid, right around 52%, even with all that cost pressure.
So they're not getting squeezed?
Not at all. It shows they can effectively, put a little tax on the urgency of that repair. What's fascinating here is all the normal rules of supply and demand, they just kind of disappear when your card is dead on the side of the road.
You pay what you need to pay.
You'll pay the price. The alternative is just so much worse.
That's a powerful economic moat right there. But it's not just about the crisis moment. What about the softer side? The brand trust, keeping customers coming back.
That's a great point, and it's different for their two main customer types. First, you have the DIYer, the do-it-yourself person.
The person working in their garage on a Saturday.
Exactly. For them, the AutoZone brand is basically a promise that they'll get the right part the first time.
Which is huge, because there's nothing worse than spending hours taking something apart only to realize you have the wrong piece.
It's the worst. And cars are so complicated now. You really rely on their system, their people, to make sure you get the right SKU. So that trust is critical when the cost of getting it wrong is your car staying broken all weekend.
And I imagine that trust, that stickiness, it's even more important for their other customer group, the professional mechanics, the do-it-for-me segment.
Oh, it's magnified by like a factor of 10. For a professional garage, AutoZone isn't just a parts store. It's a logistics partner.
What do you mean by that?
Well, these mechanics integrate AutoZone's ordering systems and delivery schedules directly into their own workflow. Their entire day is planned around when parts are going to show up.
So it creates switching costs.
Massive switching costs.
Yeah.
If some competitor comes along and offers a 5% discount, the mechanic has to think, okay, is it worth retraining my entire team on a new system, disrupting my whole shop schedule?
Probably not.
For a 5% discount. No way. It's just too costly and risky to switch. That locks in that commercial business and makes it a really reliable, recurring source of revenue.
And I wanted to touch on their internal culture, too. The promote from within thing seems like a small detail, but it feels important.
It's hugely important, and it's often overlooked. By promoting from within, they make sure the people at the counter, the ones talking to those high-value commercial customers, have deep, specific knowledge.
They know the inventory, they know the system inside and out.
Right. And that expertise means fewer mistakes. Fewer mistakes reinforces that brand promise of getting it right the first time. In a business built on failure, reliability is everything.
Okay, so we've got this powerful engine of necessity. But how do they defend it? Let's get into the moat itself. What stops a competitor, especially a giant like Amazon, from just coming in and eating their lunch?
The primary moat isn't the brand, really. It's the logistics. It's their massive, dense, and incredibly complex supply chain network.
This is where the mega hub strategy comes into play, right?
This is the absolute core of their competitive advantage. So AutoZone figured out that while every local store needs to have oil filters and batteries on hand,
The common stuff.
the common stuff, yeah. The real way to win, especially with the professional mechanics, is to have the obscure parts available. You know, a specific sensor for a 12-year-old BMW.
Which a local store could never afford to stock. It would just sit there forever.
It's totally uneconomical, and that's what the mega hubs do. They are these giant super centers, and they stock hundreds of thousands of those weird low-frequency parts.
And they're placed strategically to service a bunch of local stores and garages.
Exactly. So that garage that needs the weird BMW sensor can get it shuttled over from the mega hub in a couple of hours. Same-day delivery. That 45-minute to 2-hour window is what matters.
And that's the key to the Amazon question. Because Amazon is amazing at next-day delivery.
They're the best in the world at it.
Yeah.
But they can't solve the 45-minute problem, not at scale.
So if you need floor mats, you go to Amazon. If your car won't start, you can't wait a day.
You can't. That failure demand, that urgency, it requires physical proximity and this incredibly dense specialized inventory. Amazon would have to spend billions to build a competing network just for auto parts. The return on that investment just isn't there for them.
So AutoZone has basically built a physical barrier that a pure e-commerce player can't breach.
That's a perfect way to put it. They've leveraged their physical density as a weapon against the digital giants.
Okay, let's do a quick reality check on the margins, though. We said the gross margins are elite, but operating margins have ticked down a little bit from like 20% to maybe 18 or 19.
Yeah, and in a stock priced for perfection, any little dip gets a lot of scrutiny.
So what's the story there? Is it a reason to be concerned?
The analysis points to two main things, and neither is a huge red flag yet. First is strategic investment. They're spending money to get faster and better for that commercial segment.
More delivery trucks, better systems, that kind of thing.
Exactly. So they're choosing to invest in growth right now, even if it temporarily presses down on the margin percentage.
Okay, and the second reason?
The second is a little more technical. It's accounting, specifically LIFO charges.
Right. Last in, first out. Can you break that down for us? Because it can be a bit confusing.
Sure. So in an inflationary period like we've had, the cost of parts goes up. Let's say a brake pad cost them $10 last year, and now it costs them $15.
Okay.
When they sell that brake pad, LIFO accounting makes them record the cost of the newest, most expensive one they bought, the $15 one.
So even though they're selling it for more, their reported profit on paper looks lower because the cost of goods sold is higher.
You got it. The cash flow is still strong, but the reported earnings are temporarily suppressed. It makes the margin contraction look a little worse than the underlying business reality.
So it's a watch item, but not a panic button just yet.
Exactly. If inflation cools off, those LIFO charges could reverse and you'd see the reported margins pop right back up.
That's a crucial distinction. Okay, so we have a resilient business with a deep moat. Now let's get to the part that really excites the market. The financial engine. How they turn all this cash flow into shareholder returns.
Right, and this is really the mathematical heart of why it gets that premium valuation. It's not just a good retailer, it's a financial machine. And it starts with something really rare, negative working capital.
Explain that. It sounds like financial alchemy. How can a company that holds all this physical inventory have more money owed to its suppliers than the value of its inventory?
It's all about power. They call it the Costco-like engine. Because AutoZone is a $56 billion company, they can dictate terms to their suppliers.
So they get the parts, sell them to customers, collect the cash.
And then they hold on to that cash for 60, 90, maybe even 120 days before they have to pay their suppliers.
So the suppliers are essentially giving them an interest-free loan to fund their own growth.
That is exactly what is happening. It's this permanent, zero-cost source of financing. And it's a huge sign that the free cash flow this business generates is incredibly real and reliable.
And that brings us to the quality of that cash flow. We have to do the stock-based comp check, the SBC check.
Yes. This is where so many of the high-flying tech compounders just fall apart under scrutiny.
Because they issue tons of stock to employees, which dilutes shareholders, and then they have to use their cash flow just to buy that stock back and stay even.
Right, they're running just to stand still. AutoZone, on the other hand, passes this test with flying colors. Their SBC is tiny. It's less than 1% of their operating cash flow.
So their free cash flow is actual, honest-to-God, distributable cash.
100%. They are net buyers of stock in the open market, not net issuers.
Which is the perfect segue to the defining feature of this company, the canonical Uber Cannibal.
This is the critical lever. This is the concept from investor Mohnish Pabrai, and AutoZone is the poster child. A cannibal is a company that relentlessly eats its own shares.
And the numbers are just staggering. They've reduced their share count by something like 90% since the late 90s.
90% since 1998. It's almost unbelievable. Just think about that. For every 10 shares that existed back then, only one exists today.
So every remaining shareholder owns a much, much bigger piece of the pie.
A 10 times bigger piece of the exact same pie. And that creates mathematical leverage that is it's profound.
Walk me through that math. How does that translate to returns?
Okay, so let's say the actual business, the free cash flow, is growing at a pretty modest 5% a year.
Okay, pretty standard for a mature retailer.
But at the same time, they're buying back 7% of their shares every year. That means the earnings per share, that's growing at 12%.
Wow, so the investor's return is more than double the actual growth of the business itself.
That's the financial engineering. And that's why the market is willing to pay up. It sees this predictable, high-speed EPS growth, even if the top-line revenue is just chugging along.
It's manufactured growth, but it's very real for shareholders.
It's very real. Now, let's look at management's whole capital allocation report card.
The first test is always ROIC versus WACC, return on invested capital versus the cost of that capital.
And we already said their ROIC is consistently over 25%. Their cost of capital, their WACC, is probably down in the 5 or 6% range.
So there's a huge spread.
A massive 20-point spread. That means every single dollar they reinvest back into the business is creating enormous economic value.
Okay, so they generate this flood of cash. Where does it go? What's the pecking order?
It's a very clear, disciplined sequence. First, they spend about $500 to $700 million a year on CapEx, building new stores, building out those mega hubs. High-return projects.
Okay, and then what's left?
Everything else goes to aggressive share buybacks.
And what's missing, of course, is dividends. Almost every other mature retailer pays a dividend. Why don't they?
Management is making a very clear statement. They believe buybacks are more tax efficient for the shareholder, and more importantly, they believe their own stock is the best possible investment they can make.
By buying back shares year after year, they're essentially telling the market, we think our stock is cheap.
Exactly. It's a powerful signal of conviction. And it also shows incredible discipline. They avoid what Peter Lynch called diversification.
Right, chasing shiny objects and making bad acquisitions outside of what they do best.
You almost never see M&A from them. They stay completely focused on their core competency, which is a hallmark of a great management team. Their best idea is to just buy more of their own company.
So we have this powerful business and this incredible financial engine. But a 24x multiple means the market expects growth to continue. Where's that growth going to come from?
The biggest runway by far is what they call the commercial conquest, the professional mechanics, the DIFM market.
Because in the DIY space, they're already dominant, right?
They own the DIY space. But in the commercial market, which is huge and very fragmented, they still have less than a 10% market share.
So they're basically taking their superior system, the mega hubs and all that, and aiming it at a market full of smaller, less efficient competitors.
That's the whole strategy. They are systematically using their scale and logistical advantages to consolidate that market. That is going to be the main driver of their top-line growth for years.
What about outside the U.S.? Is the model portable?
It's proving to be very portable. Their operations in Mexico and Brazil are on fire. They're growing at double-digit rates.
So the model translates.
It absolutely translates. And that geographical diversification could become really important down the road when we start talking about some of the bigger risks.
Okay, so we've got growth levers. Let's bring it all back to the price today.
$3,300 a share, 24 times earnings. Let's try to figure out what the market is actually pricing in.
The market is paying a huge safe haven premium. Historically, AutoZone trades more in the 16 to 20 times PE range.
So at 24 times, what does that imply? What kind of growth is baked into that price?
It implies that investors believe AutoZone can keep growing its earnings per share by 12 to 15% a year for another whole decade. That feels optimistic, even for a great company. The law of large numbers eventually has to kick in.
It's very optimistic. The buyback machine helps a lot, but to sustain that rate of compounding from such a large base gets harder and harder every single year. The market is basically leaving zero room for error.
So let's try to set our own anchor. What's our own estimate of intrinsic value?
Well, we can triangulate using a couple of methods. First, let's just use historical mean reversion. What if the multiple just goes back to normal?
Back to, say, 18 times earnings.
Exactly. An 18x multiple on next year's estimated earnings of about $165 a share. That gives you a value of roughly $2,970.
It's about 10% lower than where it's trading today.
A little more than 10%, yeah. Then the second method is a simple owner earnings model. Focus on the real cash.
Okay.
They generate about $100 a share in free cash flow. Let's grow that at a healthy 10% a year and put a 15 times a multiple on it at the end. That gets you a value somewhere between $3,200 and $3,500.
So that range brackets the current price almost perfectly.
It does. And what that tells you is that the current price demands that 10% growth. There is absolutely no margin of safety baked in.
The conclusion seems pretty clear then. The stock is, at best, fairly valued, maybe slightly expensive.
That's right. The market has already priced in all the good news. For an investor to get a great return from here, they need the company to do even better than expected, or for the multiple to go even higher, which is a tall order from 24x.
All right, no analysis is complete without a premortem. We have to try to break the thesis. What are the critical risks that could derail this whole compounding story?
There's one big one that hangs over everything. The long-term terminal threat is the EV transition.
The elephant in the garage.
That's it. EVs have drastically fewer moving parts. There's no transmission, no fuel system, no exhaust. A lot of things that break on a regular car just don't exist on an EV.
So the total addressable market for repairs is just structurally smaller.
It has to be. Now, the bull case is that fleet turnover is slow. The average car is 12 years old. So this is going to take decades to play out.
Which buys them time.
It buys them time, but the stock market looks ahead. It doesn't wait for sales to actually fall before it reprices a stock.
It's all about terminal value compression.
Exactly. The minute the market starts to seriously fear a Kodak moment for auto parts, that premium valuation multiple will collapse, and it will happen long before the earnings actually start to decline.
So the current high price is especially vulnerable to that long-term fear. What about more immediate risks?
The most immediate risk is a good old-fashioned price war. Their main strategy right now is to take market share in the commercial space from their rivals, like O'Reilly and Advance Auto Parts.
And at some point, those rivals are going to fight back.
You have to assume they will. And if they decide to compete on price to defend their turf, it could get ugly for margins.
So what would that do to the financials? If those elite 52% gross margins fell to, say, 48%?
That 4-point drop would flow right down to the bottom line, and it would crush EPS growth. that 15% compounding we talked about.
Yeah.
It could easily fall into the high single digits.
And since the stock is priced for 15% growth,
A drop to 8 or 9% would be catastrophic for the stock price. It would completely invalidate the current valuation.
which brings us to the final red team challenge.
Right.
What's the sharpest, most direct critique of this investment right now?
This raises an important question. It all comes down to this. You are paying a software multiple 24 times earnings for a retailer that is only growing its top line at 5 to 7%.
The entire premium comes from the financial engineering of the buyback.
The whole thing. And if that buyback machine slows down, or if it just becomes less effective because they're buying back shares at such a high price, the whole story starts to wobble.
And if that multiple contracts back to its historical average of, say, 16 times earnings,
The stock drops 30% overnight, even if the business itself is still doing great. And that right there is the definition of a classic quality trap. A wonderful business, but bought at a price that almost guarantees a poor future return for the investor. The price risk is just too high.
this has been a fantastic deep dive. We have this business that is, in many ways, structurally perfect, but it's priced for that utopian perfection. Let's try to synthesize this and give our final verdict.
Okay. On a quality score, you have to give it an A. It's a wide moat business, negative working capital, brilliant capital allocation. It's elite.
But on the valuation score, it's more like a C+. Neutral at best. The premium is fully priced in, and it seems to completely ignore the long-term EV threat.
And based on our value triangulation, a real margin of safety doesn't appear until the stock is in the $2,950 to $3,100 range. That's the zone where you start getting paid to take on those long-term risks.
Okay, let's leave everyone with one final provocative thought to chew on.
Here's the question to consider. We know their international business in Mexico and Brazil is growing like a weed, and their commercial business in the U.S. is still taking share. Does that growth runway give them enough juice to completely offset the eventual terminal decline from the EV transition?
Or is it just buying them a few extra years of compounding before that headwind eventually hits the entire industry?
Exactly. Is it a long-term solution or just a temporary delay of the inevitable? That's something every potential investor in AutoZone needs to think about very carefully.